Hey guys, this is Imran with the Academy of Finance, and we're doing a recap of meeting two. And for the announcements, we have please subscribe to the AOF channel if you have not done so already. And the meeting date was the September 11th, 2019. And for the agenda, we had stocks, key indicators. So we continued learning about stocks, and more specifically, we learned about key indicators. So, a quick recap: stock is a liquid asset that represents ownership in a company. The fluctuation of stock prices is represented by a graph, and companies are represented by ticker symbols in the stock market. Stocks are great investments because it is simple for earnings to compound and income is passive. So, that being said, stocks. Part 2: Key indicators. So, what is a key indicator? So, key indicators are basically metrics that are used in order to assess a stock. So, for example, key indicators help you know certain things about a company, such as how much the company is worth and whether it's overvalued or not, in order to help you pick stocks with high potential. And these are a must if you want to make high returns. So, in essence, key indicators tell you crucial information about a company. So, a more in-depth analysis of key indicators. In our last presentation, I showed you guys this image of what key indicators looked like, and basically they're usually listed below a stock, but you can also search up specific key indicators on Google for certain companies, and they are essential for you to know because they enable you to make better predictions for picking your own stocks instead of investing it in a regular index fund. So what I mean by this is, when you buy the index fund, you're basically buying a bundle of stocks, right? So you're going to get the average of all those returns. But if you're able to learn key indicators and make better predictions for picking your own stocks, then you can get higher returns of like 20%, 30% instead of a regular index fund return of 8% or 9%. So another indicator is the open, and in essence, the stock market is open from 9:30 to 4 o'clock p.m., and the open tells you the price of the stock at 9:30 a.m. So if we see on the graph right here, the stock's price at 9:30 a.m. was $209.39, right? So the open, therefore, for that day would be $209.39 because it was a stock price at 9:30 a.m. And this is important because you know what the stock's price was at the beginning of the trading day, so you can make short-term decisions. But if you want to make long-term decisions, it's going to play a less important role in the decision-making process. So another indicator is the high. So the high, in essence, tells you the stock's highest price for the trading day. So when making short-term decisions, the stock's high can signal what to do. What I mean by this is, let's say the stock's high for that day was at $212.73, right? But then the open price, for example, was at $210. So it would be a bad idea to buy the stock at the high price because you would be potentially have the chance to lose money in the short term. So obviously when making short-term decisions, the stock's high may be important in order to signal what to do, but overall when making long-term decisions, the stock's high price is not important. So another indicator is the low, and this is the exact opposite of the high. So it tells you the lowest price of the stock for that trading day. And this is important when making short-term decisions and less important for long-term decisions, unless in a recession. And I say this because, a stock's low price for that day could be the stock's low price in the past 5 or 10 years, which can play a huge role in the stock's price over the next few months or years. Because what tends to happen is when some investors, when they see that the stock's price is at an all-time low, they tend to take their money out of the market. And when you have all these people when you have all this volume of money going out of the stock and out of the company, it causes the stock's price to go down because the company has less money from investors, right? And that being said, another indicator is the market cap, which tells you how much the company is worth. So when we look at the market cap, we're looking at value, right? And the market cap tells you how much the company is worth and can signal a trend in a company if you compare the market caps at different times. So for example, if you looked at Apple's market cap in 2007, right, and it was, for example, $600 billion, and now today it stands at $953 billion, that would be a good indication for you to buy, since the value of the company is increasing, and since when the value of the company increases, the stock price increases. Why? Because the stock price represents a piece of the company. So it's important when making long-term decisions, but less important when making short-term decisions. And one thing I want to emphasize is when making long-term decisions, you also want to look at other things such as 10Ks and 10Qs, which we'll discuss in a later video, but now we'll focus on the technical analysis of things. And another indicator is the PE ratio. So the PE ratio tells you if a company is overvalued. So right here we see that Apple has a PE ratio of 17. So what I usually do is, what I usually say rather is generally a company with a PE ratio of over 17 is considered overvalued. However, the prediction on whether the company is truly overvalued or not is dependent upon the specific company. So why? So this is because, if a company could have a 24 PE ratio but still be undervalued because they have high growth. They're growing really fast, that they have the ability to keep up with that overvaluation. So knowing this, whether or not the company is truly overvalued is dependent upon the specific company and how their financials are going. And this is important when making long-term decisions, and a bit less important when making long-term decisions, unless you're like trading an earnings call or something like that. And another indicator is dividend yield. So a dividend yield signals how much money you will make for owning a stock. And now, this is different from the stock's appreciation, however, but this is basically the percentage of the stock price that you will get just for owning a stock and being a part of the company. So if the stock's price was at $100, for example, right, and the dividend yield was 1.46%, that means just for owning one share, you would get $1.46 just for being a part of the company. And the percentage is what percent of the stock price will be paid as dividends, right, as we mentioned. And this is separate from appreciation and is money that is given just for owning a stock. We've also mentioned that. And some stocks in the stock market pay dividends while others do not. So if you want to know if a specific stock pays dividends, or free cash rather, just for being a part of the company, then you can just do a quick Google search and type in, for example, dividend yield for Disney to see if Disney stock has a dividend yield. And if nothing comes up, most likely they do not pay dividends. But if something does come up, you will see this percentage. While if nothing comes up, you'll just see a dash over here. So another indicator is the previous close. So the previous close tells you the closing price, which is the price at 4 p.m. since the stock closes at 4 p.m. for that previous day. This is important because it tells you what the stock's latest price was on a weekend, since the stock market is closed on weekends, right? So what I'm trying to say by this is that, on Friday, for example, at 4 p.m., the stock may close at a certain price, right? But you're checking the stock out on a Sunday, but the stock market is closed. So what's going to pop up is the previous close for that stock, which is the stock's price at 4 p.m. on Friday, right? So this can help you prepare for a decision to make when the market is open on Monday. So the 52-week high tells you the highest price of the stock over the past year. And this is important because it tells you what the return on investment of the stock was over the past year and can thus aid in your decision-making process. And what return on investment means is, for example, if last year you had $100 and this year you have $130, your return on investment would be 30% because $30 is 30% of $100, right? And the 52-week low is the exact opposite of the 52-week high, and it tells you what the stock's lowest price was over the past year And this can help in making decisions because it can help you identify if a stock is undervalued by comparing it to the current price. So we did take questions. We took up to 2 questions per person. So a quick recap. So we now know that key indicators help us make accurate predictions in the market rather than having to invest our money in an index fund. Open shows you the stock's price at 9:30 a.m. of that day. The high and the low shows you the stock's highest and lowest price for that day. Market cap signals how much the company is worth, so value, how much what the valuation of the company is. P/E ratio signals overvaluation of a company, and we said that P/E ratio over 17, right, will signal overvaluation in most cases. And dividend yield is the amount of money a company pays to shareholders expressed in a percentage of the stock price. Previous close is the prior day closings price, and the 52-week high and low shows you the highest and lowest price of that stock in a year. Thanks for your participation.